Good evening, ladies and gentlemen. This is Clueless A Trading Frank. It's approximately 8:10 p.m. on October 25th, 2018. This is a very quick update on tactical trading charts and the roadmaps that I produce on a real-time basis to benefit all my members. Tactical traders are benefiting tremendously and profiting throughout these extreme volatility and extreme volatile markets almost every single day, depending on how fast and how quickly they are understanding the levels on the chart and trading off them. On that note, full disclosure, this is purely for financial education, not for any solicitation or advice. Session will be recorded, uploaded to the Clueless A Trading Google YouTube channel for later viewing. Obviously, it's a Thursday evening. It's been a long week for active and semi-active traders. No one seems to have popped in yet, but that's okay. You guys can listen to this at your own time. It gives me a chance to go through these things rather quickly. Before I go any further, a couple of very important points. We all know what's going on, right? That's actually the most important point. We know markets are super volatile. The bearish sentiment is at an extreme to a level that has not been seen in a while, in a long time. Overall, traders, retail emotional traders, are extremely bearish to the point where even in between these 500-600 point rallies that we get sporadically off deep oversold conditions, they are not taking advantage whatsoever, despite the constant guidance through these tactical roadmaps that you are seeing in front of you. Anyway, each to their own. People need to do what they need to do. I have to say that there are quite a few traders too who are taking full advantage of this volatility and making some very decent money on an intra-week, intra-day basis off these massive moves in the market, up and down, up and down. I am still long biased. Despite the fact that the markets have some very severe technical damage, we are playing what we call the $5 million words reflex bounce / rally. That is where big money is made. You can certainly make money on the short side. We have to be very, very quick because the short covering programs come in and the markets ramp up big time, even sometimes during the day and in most cases overnight. On that note, futures are down about 20 points. Amazon is down. Google is down, not to the same degree. Amazon is down quite a bit. And obviously that is affecting the overall futures market. We do have Intel, I believe, that's up. And Chipotle is up. But those are not real big market movers. It's Amazon and the Googles which dominate the landscape tonight. We have had huge earnings movers from last night too. Overall, our earnings baskets are doing quite well. In between a couple of hits, losses, the others are just going through the roof. Most important ones that no one needs to be reminded on. If you have a close eye on my Twitter feed, or as well know a little bit about what's happening in the stock markets, was good old Tesla. We had a slew of earnings winners today. We had Tesla, we had Microsoft, we had Shop, we had Visa. You name it. You know, it was a absolute earnings galore on the list that was produced last night for traders to take advantage of. On the earnings note, keep in mind, I always do the basket approach where you buy a little bit of each of them and let it go. And as part previous past performances, those baskets tend to work out extremely well because some of them go through the roof, some of them don't do anything, and one or two of them basically go south. So that's why we take the basket strategy. So you're not held hostage to one or two companies that you're putting all your money in on an earnings trade. Every earnings trade is a 50-50 gamble, being the market volatility that is prevalent right now. Obviously, even a slight a weaker guidance or it's a miss, smash the stocks, and then you can of course play it the next day on any type of bounces or what we call reversal trades. But that, again, is not something that happens on every stock that falls, but it does happen in some of them. We know October, keep in mind, as I've mentioned many times, is a month of severe volatility. Generally speaking, in other years, the second half of October has been somewhat of a positive move overall. This year, that has been chopped up in a big way in between very large swings, primarily on the downside and some very large moves on the upside. Today being one fine example of that, and that has to do with the rebalancing, and one of the reasons, the rebalancing and the restructuring of portfolios of the mutual fund complex, which is 800-pound gorilla in the market, and their fiscal year ends on October 31st. October 31st is Halloween. That is next Wednesday, and you are going to see, again, nothing new. We're used to it. We're playing it very nicely on multiple trades. The next couple of days are going to be, again, extremely volatile. We have 1, 2, 3, 4. We have 4 trading days left until the end of the year. There's going to be a lot of chop. There's going to be deep oversold conditions. McClellan oscillator is minus 200. Stochastics, starting to double bottom, things like that. And this is a basing process. Not to say that the markets can go lower. My monthly charts are still showing that the markets will go lower. However, my weekly charts and stuff are also showing that there's some substantial bounces along the way. And that has been happening almost every 24 to 48 hours. Nothing new about that. Okay. All right. On that note, this is a pure trader's market. This is not a market where you sit around and say, okay, everything's confirmed. Now I can go to bed and wake up 3 days later and I'm going to have triple the money in my trading account. No, it's not like that. Oversold, overbought conditions are being reset within an hour to 2 hours in some cases. And each of these candles that you're looking at on the downside and the upside are showing a pattern symmetry that is very identical to what happened back, as I've repeated many, many times, back in February, March, April, even in a smaller way in May and June. Okay, so these are the relevant points that we are using as a past pattern symmetry, and believe me, there is absolutely no difference between this type of move and this type of move that occurred back in March. Traders who are tactical traders and try to keep their emotions at check and are disciplined, because that's really what trading is all about. It's probably one of the most disciplined professions that you have to deal with, because you have to discipline your mind. So disciplined traders can clearly see the pattern symmetry, the big, intense volatility. 100 points, 200 points, up, down, then a double bottom created, and then the market basically started to, again, there was still volatility, but it moved forward. Will this be the same pattern here? Absolutely. You're going to keep on seeing these type of moves, keep on seeing this type of move. Levels have been posted consistently, showing you what the roadmaps are. And if they break, you have to go in the longer term charts and the weekly charts to see how far we can fall. And if they break up, it's not off to the moon. It is simply the fact that the markets have a certain level to rise before they start going into the retracement mode again. This is the way the markets closed today. Futures are down now about 15.5 points, primarily because of the earnings misses from Amazon and Google, or weaker earnings, or just the way the market looked at it. So you're going to see that being played out in the form of candles starting again tomorrow morning. This is the S&P chart, so that's why you're not seeing any real-time movements. But this is what the static picture looks like. So if you look carefully, and this is what I've trained my eyes over the years to look at, the candle symmetry on this and the tight range trading, which are hundreds of points back and forth, is pretty much exactly what is going on here, and will continue to go on for the foreseeable future going into the early part of November. Not to say that mid-November everything is going to be all peachy and the markets are just going to go up in a straight line, because markets never, ever, ever go up in a straight line. Even this monster rally that occurred from the lows of March, April, and May did not happen in a straight line. Retail traders have a tendency to simplify things, because everyone in life, no fault of their own, as human beings, we like easy answers. We like easy things. Well, easy peasy is all fine, and we're still making some very decent money off these volatile markets. But like the saying is, trading is actually quite simple. It's just understanding and acting on it, which is very difficult. Trading is all about, okay, you buy here, you sell there. But how you manage your trades along the way is what makes you the money. Whether it be a massive intraday trade or whether it be a swing trade is really where the discipline falls apart and traders succumb to their inner fears and whatever it is, SOA, bunkers, diapers, complete irrational behavior, dogmatic, okay, it's completely going to crash and burn, or if the markets are looking good, oh, that's it, it's going to keep on going higher. And you keep on hearing the same thing, not only in our chat rooms, but across the trading universe. We are, after all, emotional beings, and that emotion is manifested in your trading, which causes massive losses. And trading losses can be explained in two ways. One is the money you lose by not making it, not catching big reversal rallies, or money you basically lose because you get caught into this type of big flash crash downdraft. Most of the times in the history of the bull market recent bull market that started in 2009, we're still in that bull market, by the way. Overall, when you look at the longer term picture, the most of the money that you have lost is the money that you haven't made. Now, it's a fact because it's happened to me too, despite the fact that I try to focus myself as a very disciplined tactical trader. I also succumb to, because of the deep, vicious, manipulated, structured volatility, we tend to basically sell earlier than what we should do. This happens to everyone. In most of your cases, I would assume it happens a lot. In most of the cases, you do not care to buy. And the most recent example was yesterday. The tactical lows and then enjoy 200, 300, 400% or 100, 200% on the move up as the markets open and rush forward. Don't forget, we were up 500 plus points today alone. And I would say a good number of at least the people that I can measure on the chat room did not participate in that rally whatsoever. Again, it's not my job is not to walk you guys through that. You guys need to do what you need to do. So losses on trading can be described in two ways. One, money that you're not making is money that you're losing, and that is actually the biggest amount of money, because you're not doing anything and you're not buying these tactical lows and making the money off that. And the other part is money that is lost because you get extremely scared and sell at the wrong times, or we get caught into a 600-point downdraft and you panic and you sell. So that's really, how money's lost. All right. On that note, let me just flip through the charts and keep this real short. So here is your short-term chart that traders can use very effectively. My short-term charts are extremely precise on the levels. You can trade these all day long. One of the things that I started using, changed to a while ago, but thank you to Bob for re-mentioning that to me, is the VWAP line, the blue line here, value weighted average price. Want to know the definition of a VWAP? Go to Investopedia and just read up on it. So this is a good measure of markets basically hugging the VWAP. This is how it was today. And generally speaking, rule of the thumb is that if it generally tends to stick to the to as close to the VWAP or come and retest it, whether it be from the downside moving up to retesting it or from the upside moving down to retest it. When it falls too far away from it, it tends to have mean reversion and go back to it. It's just simply another tool that you can use to see it visually when you're trading something. Similar to moving averages, similar to other stuff. Okay, so this is the SPY. This is a 15-minute chart, and you can clearly see that this is very tradable. I put the lines up here so that you know pretty much where the big support levels are. In this particular case, that was the trading range, and that will be the trading range tomorrow morning, in my opinion, because that's where the markets are going to fall to, maybe at the open tomorrow. I doubt that much, but probably around here where we are, 268.54. The SPY's closed at 270. Next, you have a extremely powerful trading chart, which I hate saying this, but I will say it, even a child can trade. So This is a Fibonacci retracement. This is the 50 Fibonacci, and this was the big drop yesterday. And the 50 Fibonacci has remained as a very powerful resistance. We shot above that on the 17th of October, which was last week. Pull back, and now we are here. We moved. This was the big, humongous flush capitulation panic sell yesterday. Stops getting triggered. Phenomenal buying level, as I said, the perfect moment. This was your 500-point rally. This is what you're seeing after hours at the futures down 17. Fibonacci levels are extremely important because they tend to be during extreme volatility. Fibonacci can be used very effectively to see where they will bounce up to. In between, there are all the supply zones, which is basically the sell zones. This is where the crash started yesterday. This is really where the crash started yesterday, which was around 1 o'clock. But this was the market open, slightly before market open. And you can clearly see here these lines are extremely precise. So as a active trader, and again, I've said this a zillion times, say it again, you can use this chart very effectively because it's all structured. It's showing you. And there are no stochastics, nothing, just levels. Like I said, trade the arrows, trade the levels. So again, now that we are down about 16 points, so let me zoom in. So we're down about 14 points, 14 and a half. This is a short-term chart. So again, is it possible that we come back and retest down here? Market's down a couple of hundred points again? Absolutely. Will I be crapping in my pants and running away from the market? No, I'll be engaging the market at these levels and scalping and making money and setting up trades and just making money. Because that's really what the business of trading is to make money, not wait around and say, okay, if money's just going to come to me when I'm not in the game. You always have to be in the game with small, at least some level of money. It's the way it is. So again, this might seem extremely negative to some people, but then, like I said, when we are moving up here and this is just one chart I'm showing you guys. My other charts were telling me that we were getting overbought. I repeatedly said take partial or full profits, day trading profits off the table. When the markets gap open big time in the morning, you always have to sell your profits. You keep your core positions, sell your profits, or sell the whole thing and re-enter. It's not that hard. It's only hard because your mind just doesn't want to do the hard work. So, and it's not easy either because volatility is meant to confuse and decimate your rational thought process. And that's exactly what they succeed in doing with most undisciplined traders because they know they can whack them around by just moving the prices around. That's what machines do. That's what algos do. Okay, so this is where we are. So this is the level that we're looking at as a major support, which was Wednesday's lows, and that was 26.51. Pretty easy to understand it. Just have to look at it. That's all. This is a phenomenal chart that I put out today. This was the 5-minute extreme volatility chart. This was the close yesterday, which was the perfect buying moment. At between 3 and 4 as everything was let go. And again, normal standard procedure, human behavior. Everybody was completely terrified and bunkerized and just, fastening their third diaper or just not doing anything, period. So, bottom line is the market just took off. Is it that easy? Yeah, sometimes it's that easy. There were multiple advanced indicators that I was showing, this is a live 5-minute screen, so you're seeing futures moving around. The indicators get sold to that degree where I showed multiple, and I'm not going to repeat the same things again. I showed the trend, I showed the McClellan, I showed the stochastics, there's a slew of them. And he knew there was going to be a powerful tactical bounce. I said that repeatedly. Expect a sharp reflex bounce within 24 to 48 hours. Well, you got it. You got it. If I give you 500-point bounce, good for hundreds of percent on options trades. Many of you, hopefully, many of you took advantage of it, and the ones you didn't, I have nothing to say. Okay. So at this point, this is where we are. Right after the close, we are down from 27.23. From the highs. Futures are down right now 16 points, and this is where we are. Is it a point to get completely panicked about? No, because I see a pattern. Some of you can see that too, and you will see here that this is one level of support. The second level of support would be the climactic, complete capitulation, terrifying lows when the market plummeted 900, 600, 700 points on Wednesday. And there you go. There's a lot of stuff going on in the markets which are far beyond the normal behavior of the markets. Part of it has to do with large sell programs that keep on hitting our shores from Asia and Europe. There's a global margin call that's still being satisfied. That's because of the China market crash. Our markets have undergone severe stress, and that has also created massive margin calls. And these generally are the main reasons. Oh, then they talk about an asset allocation going on. I really don't know what that's all about. Okay, but then what the heck do I know? As if everybody's moving out of growth into value. Yeah, that's garbage. Growth is growth. These companies are still growing. Yes, if they slow down a little bit, they get punished short term. Then they rise. But anyway, main reasons I believe has to do with large sell programs that are have forced institutional margin sellouts because of the drop in prices, currency fluctuations that come about because the dollar is very strong. So those are the main reasons why we get these type of massive swings. Prices get whacked around 3, 4, 5, 6, 7, 8, 10, 12, 15 bucks on these bigger name stocks within seconds, right? So the speed of this manipulative volatility every single morning, every single afternoon is tiresome. It's very tiring. And I'm very tired. But through all that, my charts are at least showing you the levels where you could be a buyer and showing you the levels where you need to be a seller. As you know, I don't get all excited telling you all guys to buy hard at these levels. I get pretty excited when I see these type of things, and I primarily am a buyer at these type of levels. So, again, it's the way it is. I said there was a massive resistance here. I said there's a massive resistance here, which we took out. And we're getting close to that big fat line in the sand, the 2730, with the downtrend line intersects. And obviously, you want to be a seller prior to that. So you would be a big seller at these levels. Okay. So again, use these charts, extremely useful. The Fibonacci retracements give you a reference point as to how far we can move. And that's it. Really no rocket science about this. Next chart is your daily chart, which I've zoomed in. And you can clearly see here that this was a candle that developed. It cuts out all the noise of the 5, 15-minute, 1-hour charts. It's just showing you the daily flow of money in the form of candlesticks, red or green. This was yesterday's massive breakdown, and today we took almost 3/4 of it back before the market pulled back. Right? So everything is there. The lines are there to show you this is a major resistance right there with the breakdown started yesterday at around on 10/24 yesterday. So obviously, as you get closer to it, you're going to see some big sell programs. Along the way, you have a downtrend line that needs to be taken out at around 270, 246. This being the SPY spiders. And again, the more you look at these things, the more your trading becomes easier to handle. Let's just put it this way. This was a very positive development on the double bottom full stochastics. I've explained this millions of times, so I'm not going to explain it again. Generally speaking, that is a very powerful signal. Does it have to go higher? No, we could do a triple bottom tomorrow for all I know. But this is a bottoming process. A bottoming, just the way I said it, it's a process. It's not a 1 day, 2 hour event. These are bottoming processes, right? Right there. Multi-day, multi-day. What does this do to retail investors? It frustrates them. It annoys them. They just can't handle it. Like too much because for a simple reason. Retail emotional investors have little to no discipline whatsoever. It's everything about what is happening right now. The recency bias disease syndrome. So they never look to see the hundreds of percent that they can gain on these type of moves on the market. They're always focused on every little candle that is happening now. Never want to believe that we can actually go back to 28.10. We could do this very well and get up there, but one way or the other, the markets are going to bounce towards these levels. Maybe we slip and slide a little bit lower. So that brings me to my next point. Straight out behavioral finance. If you have cash on the side, why aren't you excited to buy cheaper prices? Honestly, you don't need to be a crazy trader every single day using up all your trading capital. Why not? Doesn't matter how big your account is, because that's the BS excuse I've heard for many years. You can have a small account and still have cash on the side. Because those SPY calls, which we want to play the pure market, are not $10, $12. That's why I said the best way to play these type of highly extreme volatility is just buy the market, the SPY, the SPX, the QQQ, the IWM, which we haven't traded recently. So things like that. You buy the options on these things, and they don't cost a fortune. Why risk it on just one individual stock and just say, okay, I'm putting everything in there, and if that doesn't work because of some sort of individual stock risk, case in point Amazon, or case in point Tesla for the shorts who basically got skewered again, and the longs won big 2 days in a row. First day was 1,400%. The next day was another 80, 90, 100%. So the key is that you need to, if you have some cash on the side, or you're sitting around still watching the market, waiting for some perfect moment, such as yesterday afternoon, which you never took advantage of, for the ones who didn't, why aren't you excited with lower prices? Why do we have to get excited with higher prices when we're not in that position? Does that make any sense? To me, it doesn't. Yeah, it feels good when something's trending higher because you feel like some sort of comfort that, yes, if it's moving higher, it's definitely going to move higher more. No. In this type of extreme volatility, what moves higher is what you sell, as long as you buy the lows. It's such a simple method of making money in extreme volatility. Yet, very few human traders do that. You should be excited when you see prices pulling back and getting cheaper. And in between, you can do some quick short trades or do whatever you need to do. But be careful about the short side, because the market is like a coiled spring at this point with extreme behavioral and technical readings which have not been seen for years. There are minor positive divergences in play and stuff going on which can just snap your neck if you're too heavily short. Or if you do some quick shorts and put some stops in there, just the way you know. Anyway, that's just my 2 cents. So I still don't get it why people don't get excited with cheaper prices. And the cheaper prices always come off these type of basing patterns, as you can see. It's not a one-day scenario. It's a multi-day situation when the basing is happening. That is the same story here. Okay? This could be a basing pattern for the next 1 week. You can trade these levels like we are, or you can buy, or you can basically buy the lower end and hold on to it if you don't want to sell up on this intermediate range higher. Because when it gets up here to these levels, believe me, it will. At some point it will, before it sells off again. But then you're not chasing up here and making no money. Just simple suggestions, some guidance. guidance. No advice, just guidance. All right, next chart. Again, this is a a daily chart of the S&P 500, the actual SPX, and this is what's going on. Now, each of these levels, when they get close to it, you're going to see sell programs. Each of these levels, when they get to it, you're going to see buy programs. That's why we have arrows to guide people. Like I said, just trade the arrows. Forget about understanding patterns. Forget about understanding stochastics. Nothing. Just follow the arrows. This is 2018, right? This is the beginning of 2018. So we gave back, like I was walking people through on my absolutely perfect real-time service, where I'm showing it through visually as well as my comments, what is going on. We went negative for the year. Now we're a little bit positive for the year. Very little positive for the year. What, 2% on the S&P? That's a joke. This channel that you're looking at, let me zoom in. Upper end of this channel is 2790. That's about 540 to 600 points from here, or 700. Lower end of the channel is the 2600 level, if not 2594. Both can be engaged. Given the level of the stochastics that's there right now, I would assume that it reaches here faster, or it can slip and slide a little bit more before it gets up there. But the gravitational pull, in my opinion, at this point is towards this level. No one's saying the market's going up all the way to new highs. Forget all that stuff. I'm simply looking to see the simplest formation, which is the full stochastics, which generally tends to create a basing pattern, as you can see a double bottom here, and then shoots forward. And that shooting forward could be simply this move here before it sells off again. Because remember, we're still in a downtrend. By looking at the downtrend, you're not going to make any money. You got to play the moves in between this downtrending channel. Once it breaks out of the downtrend, that's a different story. Then we can talk about the next huge sell zone or supply zone, which was at that 2875 level. All these effects, all the trade stocks, most of the stocks that we're trading on the front side, and primarily the stocks which are directly tied in with the market, such as the Boeings of the world, which we did extremely well on. That was another major earnings winner. And before that, I hope some of you took advantage of it. You woke up the next morning, Boeing's up $14, $12. Calls up more than 150% overnight. There's always an excuse one can give themselves for not making money or staying fearful and scared all the time. But that won't do anything for you in any market. Because I still remember when the markets were climbing every single day, there were very few people who were actually making money. So in a bull market, you can make money. On a short-term pullback or let's call this a very short-term bear market situation, you're not making money. So what the heck are you doing? That's one of the reasons why traders, instead of pointing the finger at them, they pointed at the market, they pointed at the subscription service, they pointed at the charts, and some of them quit. Good for them. The lesser number of retail traders that we have involved in the market, the better off us tactical traders will do in this market. And that is a fact. All right, next. Same chart, a lot more lines and stuff, cups and handles, things like that, right? Same double bottom formation. These are the swing charts. And this is your longer term chart, which I was going to tell you earlier, which is the monthly chart. But the monthly chart has broken down. So which is telling me that there is going further selling to be done. This is the monthly chart of the E-minis. And this is telling me that this is now broken. Either it turns higher, that means the market has to reverse itself back into the rising wedge. This is the rising wedge going back to 2016, the November elections of 2000. I'm sorry, this was beginning of 2016. The elections were down here. So as you can see here very clearly from a pure technical, have a technical eye when I'm explaining this, is we were on this beautiful rising wedge. We got to the top of the wedge and we fell back. Now we broke below the wedge, so we need to attempt to go back into it. And that going back into the wedge means that we have to go above the 2760 level to resume some sort of uptrend. We don't care because each of these moves here are worth hundreds of points and you can trade them very nicely. However, one has to admit the fact that this candle is so large, so deadly, so much money's been lost, trillions of dollars, okay? Not just here, overseas too, that it takes a little bit of time for that damage to be somewhat repaired. We get 500-point rallies, make a ton of money intraday, doesn't negate the fact that this is a very ugly red candle. So from a technical standpoint, we will get these quick move ups, but they're all meant to be sold for now, till we see a sustained recovery on the underlying stochastics and other indicators that we follow. Simple English, sell the pops. That's what we do. That's what we do. So even if this retraces back, you can rest assured they will try to resell it down. And if this is the head and this is the right shoulder, left shoulder, and this is the right shoulder, and on a maximum move, we get up all the way up here, which is possible on some sort of China deal, some handshake, saying, yes, we're going to work with China back down towards the latter part of November 20th when Premier Xi of China meets President Trump. We could get 1,000-point rally in 2 days, or a day even, 800-900 points. You can, trust me. But that simply brings us up to the right shoulder, where, from a technical standpoint, it's a sell zone. But that's a long way off from where we are right now. We're at 2,700. So if we get up to 2,880, you're talking 180 Dow points, which is roughly, 180 S&P points. That's roughly 1,000 points from here to here. Like I said, it can happen. But that needs to be sold. In between, you get 100, 200, 300 points back and forth. Make money. Just make money. Little money, fine. Just make some money. This damage to be fully repaired will take time. Not years, months. Or maybe sooner. But so far, this is telling us that these bounces that we get, they need to be sold. They need to be bought at certain levels, and they need to be sold. And if it cracks here, the 2750 level, we're going to 2530 real easy, which was the multiple long tail support, long tail reversals or support back on the earlier part of 2018. And if you remember that, I remember it clearly because I was active in it. We did well in it, and we learned how to deal with volatility. So now we have a reference point of how to deal with extreme volatility. Each of these candles are 1 month candles. 1, 2, 3, 4. All pointing higher, like the Chinese firecracker, telling us the markets were going to go higher. One of the simplest way to read candlesticks. Here, we don't have that yet. We need to see one where the candle looks like this with a long tail. We don't have it yet. That's why the stores are still going down. One more push down, 2 more pushes down, whatever the case, we bottom somewhere around here, and then we create this massive double bottom like we did back in 2015. And you know, when that happens, you get a multi-month rally. Multi-month rally. In between, massive volatility intraday, intra-week, but month after month and month, you're trending higher. Maybe that starts from down here, in my opinion. Because that would create let me clean this out. This is the bigger picture. There. Okay? And unless you are trading charts and try to be as unemotional as possible, you will never, ever be involved in this type of move in the market. Not just the basing pattern, which we're making money on, but then the multi-month rallies that ensue. They're never going to be there. So I'll try to help you guys as much as possible, as I always do. That's not a promise. That's my job. But just try to be engaged. Quick look at the S&P, the E-minis right now. This is where we are. These are the past patterns we're talking about. We could still go lower, reach the 2600 level. In fact, the 2600 level, in my opinion, could be welcome. Like I said, get excited with cheaper prices, because the 2600 level would mean that we have succumbed to a complete pattern reversal or pattern symmetry. And here's your the blue is the big channel, and we're basically from top to bottom, we have done the whole road trip. Now 2600 from here is roughly another 75 points, and that we can get within an hour. 75 points is roughly 450 points. So from here to where we are to 2600 is just nothing. 400 points. You get that in what these days? In 25 minutes? 30 minutes? I would welcome that. I'd welcome that. You can short if you'd like, but you got to be quick, because these moves happen real fast. So this is where we are right now. Okay? And we are, today was a large, you can see that the volume was big. After 1, 2, 3, 4, 5, 6, almost 7 days of capitulation. 3, 4, 5, 6. Today was the 7th day, and look at this massive short covering candle. They said there was no volume in the market. What the hell are they talking about? This is your daily chart of the E-minis. This is where the actual actors, the fast money, is moving in and out. And that was big. That was 2.47 million contracts right there. This is still in the process of creating a double bottom. Unlike what we saw on the other side, this, because it was slightly down, because the futures are down slightly, you can see that little blip is 12 points. Can't even see that. So again, without lingering on, we are in a severe basing process at this point, trying to think that the market will just fall apart and go to 2400 right away. And by the way, anything can happen, believe me. Anything can happen, but I'm just giving you the statistical probability of what I see on the technicals. And the key is that trying to get super bearish at these levels, where, we're at the 9th inning of this sell-off, or 8th inning of this corrective pullback, is, in my mind, a little bit too stupid. Can you be short-term, tactically bearish during the day or overnight? Sure you can. But getting super bearish at this level, it's, in my opinion, stupid. And I say that with a high level of confidence, because I've gone through so many of these. They're difficult to manage, these type of pullbacks, but we still trade them for profits. That's a fact. Just go through my Twitter feed. And the returns are large when you catch those tactical bottoms and sell in, quick, fast intraday highs or intra-week highs off my chart levels. So the pattern that we see here is very similar to here. We had 2,000, 3,000 point rallies from there, and then we did another one, and we moved on. So it's the same old story over and over again. Let's take a quick look at the VIX. I thought I had the VIX here. I'll just pull up the VIX that I'd shown you guys earlier. And by the way, these days I'm putting these charts, which I always do, but now more so with exact comments. Do read them. They're on the Twitter feed. They'll help you with your trading. And if you're not trading and looking to start re-entering the market in a small level and trading these massive volatility moves and making some money to regain back your confidence, then certainly go back to the real-time Twitter feed, because that is the ultimate source and content, precision content through all kinds of markets. So looking at the VIX here, we have a negative divergence. You can look at the stochastics. We are basically, you can see that. It's kind of, change that down. Okay, kind of pointing down. You can see that very clearly right there. Yet the VIX is still moving higher. You can see that. And again, it might create a negative divergence And the VIX is in contango, by the way. That means the future VIX futures a month, 2, 3 months out are actually lower than what the cash settlement on the VIXs are right now. So what it means is the so-called fast money speculators are betting that the VIX is going to be lower 2 months from now, or a month from now, than what it is right now. You know, the backwardation, they call it. Backwardation. It's backwards. It's lower VIX front month forward than what it is right now. It's happened a few times before. It's not a guarantee, but it basically tells you that they are less fearful about what will happen in the market a month or two from now than they are right now with the short-term volatility that we are incurring in the market, for reasons that I've already explained to you guys. And primary reason, one of the reasons being, it's the month of October, large amount of restructuring rebalances. We have emerging market currency fluctuations, which have subsided but still there. Interest rate fears, the scared of the Fed, what Jerome Powell is going to say next, and all these unfounded fears, in my opinion, because he's not going to go hog wild raising rates if he sees the U.S. economy starting to moderate, which reminds me that Friday, tomorrow, we have the GDP number. And what's the most important thing about the GDP number? The PCE deflator and also the wage component of the GDP. So we're watching that. Again, there's a lot of disinflationary pressures in the market, with oil coming down heavily to lows, to some monthly lows. And again, the market itself creates disinflationary moves when they have corrective pullbacks. All right, on that note, I got to get some sleep. I gave you a quick soundbite on everything that's going on. Selective stocks, back and forth, big winners, Twitter, all that ones. I told you guys I didn't even recommend Amazon or Google today, if you notice. I said simply play it through the Qs. So the Qs will be down a little bit tomorrow morning. I believe they can be bought because Intel came out with very strong numbers. Chips should be doing okay based on the semiconductor side. And overall, the market's in between, down, up. They want to move higher a bit as we move into November, where also the stock buybacks begin. Whichever the case, trade the charts, not your emotions. Have a great evening, guys. And please listen to this video when it's uploaded tonight. God bless you all.